Welcome back to the course. This is Lesson 8, Finance. Let's get started. First and foremost, we have revenue versus profit versus cash. And by the end of this lesson, this is going to be you, playa. You're going to be in Dubai, surrounded by Ukrainian supermodels, throwing money in the air. It's going to be beautiful. Anyway, so it's really important to understand the difference between these terms. Take a look. Revenue is the money you make. Profit is the money you keep. And cash is the money you can use at any given time. So these three terms are not the same. The key concept here is just because you make $100,000, that doesn't mean you'll keep $100,000. You might keep only $10,000. It depends on your profit margin, and we're going to calculate profit margins in this lesson. But first, we're going to talk about cash flow. Cash flow is the sum of money, cash, and bank balances flowing into and out of a business over a specific period of time. Cash inflows are things like sales revenue, loans received, asset sales, whereas cash outflows are wages, rent, utilities, because those are things you have to pay out of the business. A key metric that you really need to know is net cash flow. Cash inflows minus cash outflows. Pretty simple. Closing balance, opening balance plus net cash flow. And by the way, when you see closing balance or opening balance, that's just the amount of money that you have at the end, in the case of closing balance, or at the beginning of a trading period. This is usually counted month to month. And your key takeaway here is net cash flow needs to be positive, at least if you want to make a profit. Now, it doesn't always have to be positive. There are some months where you can go negative. Let's say that you have a seasonal business and you're really popular in the summer, like a swimming pool. Well, a swimming pool isn't really popular in the winter, especially one that's outside, right? So it's okay to go negative sometimes, but this shouldn't be a common thing. You really do want your net cash flow to be positive. And something that's muy importante, a business can make profit but still run out of cash. How is that possible? Credit. Credit sales are recorded as profit, but the cash comes later. So yeah, you made a, let's say, $5,000 sale. That's great, but that person isn't paying yet. They bought that on credit. You're allowing them to essentially buy now, pay later. So yeah, your cash flow is technically positive on the books, but in reality, you don't actually have that cash. Look at her, she's swagged out. She's swagged out, making it rain, baby. Oh, yeah. So, when it comes to cash flow, these are the key terms that you need to understand. As we've already said, opening balance is cash at the start of the trading period, usually month to month, and the closing balance is cash left at the end of the trading period. And cash flow forecasting, which is what we're about to look at, is the prediction of future cash movement. It's important to know the opening balance and the closing balance because they show how much cash the business has available at the start and end of the trading period to pay immediate expenses. They're also used to generate cash flow forecasts. Yeah, we're gonna have to generate a cash flow forecast. Don't worry, you're gonna like it. This is the cash flow forecast that we're going to analyze. I'm going to give you an illustration. Let's do it. All right, Diddy Bloods, let me teach you about the cash flow forecast. That's why I put it in this evil font, because everyone hates it, but I don't know why. I think it's because there's just so many numbers, but it's really not that big of a deal. So look here, we have the opening balance. Remember, that's how much a business has at the end of the previous trading period that they're putting into the new trading period. So that tells me that last month, which was December, they ended the period with $5,000. So they're opening the period with that $5,000. So when you read a cash flow forecast, you should think about it in three parts. First, we have the opening balance. Then we have the total inflows. Then we have the total outflows down here. So let's take a look here. In January, we opened with $5,000. Now, if we take a look at the cash inflows right here, it says sales revenue, $4,000. So we had $4,000 of sales revenue. What does that give us? Well, 5 plus 4, that's 9. So it's $9,000. Now we have to look at the cash outflows. We have rent, wages, ingredients, advertising, equipment, and that all adds up to $5,500. Now, what is 9,000 minus 5,500? Well, it's 3,500. So that's what we open with in the next trading period in February. So in February, we opened with 3,500 and we made $5,000 in sales revenue. So the total inflows were 5,000, 3,500 plus 5,000. That's 8,500 so far. Just a little note here. Now for the cash outflows. Again, the rent, the wages, the ingredients, the advertising, the equipment. That brings us to $6,500. Well, what is 8,500 minus 6,500?
It's 2,000.
Yes, good job, students. Nerd. So let's do this one more time. Cash inflows, we had sales revenue of $7,000 plus a bank loan. Now, you may be wondering,
Sir, why are we putting the bank loan into the cash inflows? That's a debt. We need to pay that back.
yes, that's true. But for now, we're putting it into our account. So that's why it's technically counted as a cash inflow. So 7,000 plus 3,000, that's 10,000. So 2,000 plus 10,000, that's 12,000. Now, what's 12,000 minus 7,500? It's 4,500. So you can do that all the way down. And you'll see that we can make a forecast based on this data. So next month, I have an idea of what this data is going to look like, right? I already kind of know. And that's really important information when you're planning to make business decisions. All right, back to the course. Welcome back from that riveting illustration. Now let's move on to income statements. Guess what? You gotta do some more math! Math! Anyway, it'll be fine. It'll be fun, actually. Probably not. But anyway, here, before we get started, we have some key terms. We have revenue. This is the money you make from sales. Revenue is just the selling price times the amount of units you sell. So if you sell 100 units and the selling price is $2, well, you just made $200 in revenue. But that's not how much you're going to keep because you have cost of sales. These are the costs of making the goods. So yeah, you sold something for $2, but it cost you $1 to make it. So your revenue is $2, but you're not going to keep $2. You're going to keep maybe $1. And that doesn't even include taxes and other things. Then we have dividends. These are payments to shareholders. Operating expenses. These are day-to-day operating costs. And we're going to take a closer look at that in a moment on the next slide. Don't worry. And then we have interest payments. These are money owed as interest on loans, usually to a bank, but any lender can charge interest. And they will, actually. They will charge interest. That's their incentive to loan you money. So whenever you pay interest on a loan, that's what this means. Interest payments. Now, on the next slide, we're going to look at how to calculate 3 different types of profit. We have gross profit. This is profit minus the cost of sales. Operating profit. This is gross profit minus the operating expenses. And then net profit. It's the operating profit minus tax and interest payments. Let's take a look at how to calculate those. So first we have the gross profit. It's the revenue minus the cost of goods sold. COGS. You'll see this pretty often in business, especially if you major in business in university, or if you're going to do AS and A-level business, you're going to see COGS a lot. Just an example here, let's say the revenue is $100,000 and the cost of goods sold is $60,000. So you made $100,000 and it cost you $60,000 to make the products that you got that money from. That means the gross profit, $100,000 minus $60,000 is $40,000. Then we have operating profit. This is gross profit minus operating expenses. So look, we just take that gross profit, that's $40,000, and then we have the operating expenses. Now, as you saw on the previous slide, these are things that are paid for the day-to-day operations of the business. So we have rent, staff wages, marketing. This is called revenue expenditure, things that you spend on day-to-day operations. So when we add all that up, 10,000 plus 14,000 plus 6,000, that equals $30,000. So we take 40,000 minus 30,000, and that gives you 10,000. So your operating profit is $10,000. Now, lastly, we have net profit. This is profit remaining after all costs have been deducted, including interest payments and tax. So let's say that the interest and tax is $5,000. Your operating profit was $10,000 minus $5,000. That means your net profit was $5,000. That's how you calculate these profit metrics. So take a look here. A pro tip for you is you should calculate these metrics in this order because look, here we use the gross profit to calculate operating profit, and then we use the operating profit to calculate net profit. So there's no point in trying to start with net profit. You have to do it in this order. So that's your pro tip. Don't waste time. Start with gross profit, then go to operating profit, and then finish with net profit. So here's a little task for you. I have some data here, some business data, and I want to see if you can do these calculations. First, calculate the cost of sales, calculate the operating expenses, calculate the gross profit, calculate the operating profit, and then calculate the net profit. You just learned how to do it. If you need a bit of a refresher, you can rewind the video a little bit. All right, go ahead and give it a shot. All right, twin, let's see how you did. So here are the answers. Number 1, calculate the cost of sales. Well, we have $50,000 for the ingredients plus $10,000 for the packaging costs, so it's $60K. Number 2, calculate the operating expenses, the day-to-day expenses here. So we have rent, wages, and advertising. $15,000 plus $20,000 plus $5,000 gives us $40,000. Number 3, calculate the gross profit. Our revenue was $120,000 minus $60,000 because we already calculated the cost of goods sold, the cost of sales, so that's $60K. Now, the operating profit. Take that gross profit of $60K minus $40K, that gives us $20K. And now we take that $20K and we subtract the taxes and interest charges, and that gives us $12,000. So how did you do on this? Was it easy? Was it hard? It should have been easy. I hope it was. If it wasn't easy, then you need to go back and review because they do have quite a few questions about this. But keep in mind, most calculation questions are worth like 2 marks. So in the grand scheme of things, yes, this matters. I'm not saying it doesn't. But should you stress so much about it? Probably not. But still, it's important to know this, so you should study it. So now that we have this information, we can make the income statement. Yay! So we take the revenue, it's $120K, and then here we put less cost of sales. Remember, the cost of sales was $60K, and we can see that on the previous slide. Cost of sales was number 1, $60K. Whenever we have a subtraction, whenever we have a negative number, we put it in these parentheses like this. This is a business and accounting standard. So $120,000 minus $60,000, that leaves us with a gross profit of $60,000. Then we less operating expenses. We minus the operating expenses of $40,000. Once again, in parentheses because it's negative, and that gives us the net profit of $20,000. So this is a very simple income statement. Of course, in the real world, it's much more complicated, but for your IGCSE, this is all you really have to know. So don't worry. And then this is me over here with the blue hair.
Profit, expenses, revenue.
And you're like, what is bro yapping about, bruh? What is this Diddy Blood doing on the calculator, cuh? Sorry, I'll stop. All right, moving on. Now we need to learn about the current ratio. We got Barack Obama blinged out on the right here. It is a liquidity ratio used to measure a business ability to pay its short-term debts. Guys, that's what liquidity is. It's the ability for a business to pay its short-term debts. So with the ratio, all we're measuring is, are they really able to? Let's take a look at the math here. The formula for the current ratio is current assets over current liabilities. Now, what does current mean? Current means anything that is going to be used in less than 1 year. Its useful life will be done in less than 1 year. So current assets, those are things like inventories, for example. Let's say that you have a clothing company and you have a bunch of t-shirts in a warehouse. You want to sell those in less than a year. You don't want to have those sitting around in the warehouse for 5 years, right? Another example would be printer paper and printer ink. Yes, that's worth money, but you're going to use that definitely within a year. And it's the same for current liabilities. A liability is something you have to pay. So a current liability is anything that you have to pay within a year. So as you can see, here we're measuring short-term assets and short-term liabilities. When you see this word current, you can think of it as short-term, less than 1 year. Here's an example for you. Let's say we have current assets of $60,000, and then we have current liabilities of $30,000. Well, the current ratio is pretty easy to calculate. We do current assets over current liabilities, so $60,000 over $30,000 gives us 2. That's the answer, 2. So what does this mean? How do we interpret this? The business has $2 of current assets for every $1 of short-term debt. So that's a good current ratio. A current ratio of 1.5 to 2 is considered healthy. That's desirable. That's how you should interpret the current ratio value. Next, we have the acid test ratio. I know that sounds kind of metal, but it's really not that cool. Acid test ratio. So this is also a liquidity ratio. And guys, it's basically the same thing as the current ratio, but it's a bit more conservative. And here's a key question for you here. Would you be happy if you invested in a company, then learned that 60% of their assets were in unsold inventory? Let's say you invest in a washing machine company and you give them your $2 million, your 2 million smackaroos, and then they say, oh, by the way, 60% of our assets are in unsold washing machines sitting in a warehouse. That doesn't give you very much confidence in the business, does it? That's why we have the acid test ratio. The formula for the acid test ratio is current assets minus the inventories over current liabilities. So as you can see, this is the same formula as the current ratio. We're just getting rid of the inventories in the numerator. And we're doing this because the business might not sell those inventories. And what is something worth if no one will buy it? Well, it's worth basically nothing. By definition, it's worthless. And just so you know, if all businesses sold 100% of their inventories, no businesses would fail. We would never hear any sad stories about business failure if everyone could just sell their inventory without trying. But they do have to try, and sometimes they do fail. They don't sell these inventories. So it's important to understand the acid test ratio because you don't want to invest in a company where they can't sell anything and they just have a bunch of products sitting in a warehouse somewhere. Here's an example of the acid test ratio. So we have current assets of $60K, but our inventories are $20K. Our current liabilities are $30K. So we do $60K minus $20K, that's $40K, over $30K. And that gives us 1.33. So it's not terrible, but that's a much different investment than the one we had on the previous slide. It's important to be mindful of these things in your life because you don't want to lose your money, you don't want to get swindled, and you don't want to make poor decisions. The interpretation here is this means the business doesn't need to sell inventories to cover their debts. Technically, one or more is desirable. And by the way, you should definitely memorize this for your exam. It's really only one formula. Current assets over current liabilities. For the acid test ratio, you just take away inventories from the numerator. That's it. Past paper alert. Past paper alert. You're about to have a past paper question, twin. Here we have happy AI-generated Tung Sahur, and we have an extract from statement of financial position of a company. So here, take a look. Non-current assets, 48 million. Current assets, 60 million, of which inventories are 40 million, and current liabilities are 30 million. Take a look at the questions. They say, define non-current assets and calculate the acid test ratio. Show you're working. So I want you to give this a try. And get out of here, Tung Sahur. We don't need you here for this. So go ahead, try it. All right, I hope you gave it a try. Let's go ahead and check the answers. A non-current asset is an item of value owned by the business that the company expects to keep for longer than 1 year. Remember, current assets are less than 1 year. Non-current assets are more than 1 year, so they're long-term. Now, calculate the acid test ratio. Show you're working. So here it is. 60 million, those are the current assets, minus the inventories, that's 40 million, over 30 million, the current liabilities. And when we do the math here, that's 20 million over 30 million. That gives us 0.66. So that's really not a very good acid test ratio. That's rough.
Anyway, let's go ahead and... Huh? No! It's evil Tung Sahur! Sir, I'm sorry! Please don't! No!